Hi everyone, welcome to this video. So this is an update for the portfolio, which we can see on the screen now. So currently we have just peaked at 15,477 at a peak of about 15.5, and we have had previously the best month of the dividend so far. So we had £103 during May. Currently we've just had £10.41 being paid by Bay Systems. British Aerospace, so it's been a very good month for dividends and the portfolio is at an all-time high. We're closing in at the end of year goal of 20,000. So getting into it, the 212 portfolio, we can see here through allocation, the largest holding being Corsair, then Aviva, Store Capital, Intel, Burford, Legal & General, Realty Income Corp, Berkshire, Lockheed Martin and AT&T. We've seen a lot of swinging for Corsair in the last week. We can see here that it peaked at around $35, and then currently went down again. It's been a lot of volatility with this stock. I continue to hold it. I think it's such a good company and the growth prospects are really good for it. Burford Capital as well, another stock I'm quite bullish on, is also 7% down. They have a current market capitalization of 1.9 billion and they have a PE of about 15. However, they produce a lot of cash, and how their business works is there's often a delay into the earnings, and they've continued building the size of their portfolio case of litigation. So that's another one I'll continue to looking to hold. We can see here the monthly graph for this, so peaking down about 11,273 up to 12,687. The reason this number differs from the 15.5 is because I still have a number of holdings on eToro, so the best of which can be seen here is Qfin or 360 Finance. This has seen an increase of 41.88%, and we'll go into why I think Qfin is such a good company to hold even at the current price. So if we look at their latest presentation, this is just one slide I want to sort of highlight as a growing case for why this company's doing so well. Is they're reducing their leverage. So we can see here it went down from about 10x. So leverage ratio is risk-bearing outstanding loan balances divided by assets, and free cash flow being cash and cash equivalents minus operational cash and cash reserve. So the amount of cash they have at the end of the day to do as they wish. So we can see their leverage is reducing and their free cash is increasing. So they're a cash generative business and reducing the amount of debt they have. We can also see here on each side, so their net income is increasing, their revenue is increasing. These are all in Chinese currency. So if we go to Simply Wall Street here, we can see the key highlight for me is in the past we can see that they've been free cash flow generative. However, they also have exceptionally high return on equities at 42.8%, and return on assets is 17%, and return on capital at 75%. So they are an exceptional business for being a shareholder, and they have also got a significantly reduced debt. So we can see here that the debt has been reducing and the cash has been increasing. So from a shareholder's point of view, is exactly what we want to see. There has been no large increase in insider trading recently in the last 12 months, with the largest shareholder being the chairman of the board. So there is a lot of interest in keeping the board invested in the company. We can also see from looking at eToro here that the company has a net profit margin of 25%, which is absolutely exceptional. It's rare to find that, at a gross margin of roughly 84%. So on to the next company I've been looking to hold more of. So we can see here Intel has had an increase of 838 from the last month. There's a couple reasons why. That is predominantly due to the low valuation. So currently just a market cap of 223.5 billion, PE of 10. If we look at some of their ratios here, we can see that they have a high return on assets, a very high return on equity of 25%, and a 5-year average return on investment of 16.5%. The previous CEO was fired. He was more sort of known as the sort of finance. He was keeping a strict financial regimen on the company, which is why some of the reasons why they're behind in terms of their 7 nanometer. However, their new CEO Pat Gelsinger, it looks very promising, and we'll hear a short clip of him shortly. Another reason why what I'm looking for when I'm looking at Intel is the price to free cash flow of roughly 15. So they produce a large amount of cash, which we can see here in the past. So we can see that their high return on equities, high return on capital, the relatively low debt, which is very manageable with the amount of cash they've got, and their growing revenue and growing earnings. We can see that they're growing their free cash flow. So we'll listen to the short.
We were at an inflection point, and we really had to make a decision with regard to being that foundry, for ourselves, but also for the industry. And I'll say there's a handful of things that have changed in the current environment. One is it's a different market. As we said, $100 billion foundry market by 2025, and there really are very few companies that can step into that with leading process technology. There's also extraordinary interest on the part of US and European countries and governments for a more balanced supply chain. And again, we're one of the few companies that can step into that. We've also come at this and said, we're going to do it the right way. And we've had some steps in the past where we, as I'd say, didn't take them as seriously as we needed to. We are now serious about being a major foundry supplier for the industry, a separate business unit, separate P&L, separate capacity that we're putting in place to satisfy those. We're also bringing the best of Intel, leading process, our unquestioned leadership in packaging.
Now, for me, that clip was really good to see. We can see here that Pat Gelsinger was talking about the improved drive for Intel. We can see that the foundries offer great growth, the 100 billion potential addressable market, which should add greatly to the profitability of Intel, and also the fact that the large percentage of them being centered around Taiwan, South Korea, and China, so it would offer Western companies a great alternative to their supply chain. Further on in the interview, he talks about how although the M1 chip from Apple is taking away business from their current Intel lineup of chips, becoming Apple's primary foundry would be exceptional for their business. So whilst competing with them, they also want to keep them as friends and as customers. So we can see here from Intel's past performance the large amount of free cash flow they've generated. So they're able to generate the money, they're able to spend the money needed to become competitive in this industry, becoming a leading foundry. They've also had exceptional margins, so we can see here return on equity 23%, capital 17.9%, and return on assets of 12.7%. So for me as a shareholder, they've had excellent management efficiency. Their dividend has increased year on year, so we see here back to 2010, a steady increase in dividends even through the pandemic. And a further benefit for being a shareholder is the reduction in shares outstanding. So we see here from 2005 to 2021, the number of shares has reduced significantly, about 1.1 billion. And hopefully will continue to do so in the future, meaning each year that goes on and you hold your shares, you earn a larger percentage of the company. So if we look here as well, Intel has consistently traded at a low price to free cash flow. The cash flow has increased over time along with the price. However, currently we're at about a 12.52 ratio, which is very good for me. It's definitely worth buying, and I'll continue to purchase more of this, given the growth perspectives and a 3% dividend. So the final point I want to make is for Intel is that the Baupost group, which is managed by Seth Klarman, who is considered one of the greatest value investors. He has written an excellent book, which I would recommend reading. around his attitude to value investing has made Intel his largest position. So it's a good bit of reassurance that the analysis we're conducting here is along the right lines, and he has continued to increase his position of this, likely at a higher share price, given the recent decline from the highs of around 60. So it's just good to see that on this aspect, we've got a large value investor who also deems this a significant purchase and has made this the largest holding in the portfolio. The final company I want to look at is Etsy. So this is just a rough estimate of why I think this company is undervalued. So we can currently see the basic price to share price versus fair value here, which is not the best measure to go off. However, it does give a general indication. The numbers can be skewed that they use, such as the discount ratio and the expected generation of future cash. However, they do have a PE of 43, so that's quite high. But if we look further into this, they have had significant free cash flow generative operations for a number of years now. So they've rarely been free cash flow negative from 2016 and have continued to grow. They have exceptional return on equity of 70%. Return on assets of 20 and return on capital employed of 26. Now, we can see here it has been skewed due to the high level of debt, which we'll now move on to. So the debt has increased, so we can see the red debt here is at 190%. So it has increased. However, they do have significant cash, which is actually greater than their net debt. So their net debt would actually not exist as their cash is greater than their debt, which is very good for what we want to see because they're able to pay it off easily if they need to. So that's it for this video. Let me know if there's any other companies you want me to look at, or if there's any comments or questions, please let me know below. And thank you very much.